What is the impact of making an after-tax IRA contribution? And what is the pro-rata rule? And how does this impact a Roth conversion? Answers to these questions in this episode of the Financial Fast Lane. Welcome to another episode of the Financial Fast Lane. My name is Lane Martinson. I am a financial planning practitioner. And on this educational channel, we discuss retirement planning topics for those over 50 specifically. Now, the tax rules for individual retirement accounts, or IRAs, can be very confusing. And my goal is to present the information to you in a way that is easy to understand. So when you contribute into a traditional IRA, most people receive a tax deduction. The money grows tax deferred, and then when you take distributions in retirement, those distributions are then taxed as ordinary income. When you contribute to a Roth IRA, you do so with after-tax dollars. The money grows tax-free, and future distributions are also tax-free. So depending upon your situation, you may want the tax deduction now to lower your current tax burden. And for other important reasons, you may want, or you may be interested in building up an account that will be free of taxes forever down the road. So not everyone is eligible to contribute directly into a Roth IRA because of income limits. So if you take a look at my slide here, if you are single and your income exceeds $125,000, you are phased out of making direct Roth IRA contributions. You're completely phased out when you reach $140,000. If you are married and filing jointly, then the phase-out limit starts at $198,000, and you are completely phased out at $208,000. If your current income level does not allow you to make Roth IRA contributions, you could do a backdoor Roth, which is the process of making a traditional IRA contribution, and then afterwards converting to Roth. And there are no income limits on Roth conversions, like there are with Roth contributions. Understanding the deductibility of traditional IRA contributions is important. If you're not careful, you could end up paying taxes twice on the same money, and nobody wants to do that. If your plan is to do a backdoor Roth, you may be thinking, I don't really care if I get a tax deduction because a Roth contribution is after tax anyway. But there are some important things to understand with after-tax contributions to a traditional IRA, regardless if you complete a Roth conversion or not. So if this sounds confusing, I understand, but stick with me and I'm going to give you an example scenario that I think will simplify things for you. So many times when discussing IRA contributions with new clients of mine, I have heard them say, I'm not eligible to contribute into an IRA. And I ask them, well, who told you that? And they say, my accountant or my CPA. And then I explain that they are, in fact, eligible to contribute, but it is a question of deductibility. The IRA deductibility rules are based on if either you or your spouse have a company-sponsored retirement plan, such as a 401k. Again, if you take a look at my screen, this is only for those who are covered by a company retirement plan. If you're single, you're phased out starting at $66,000 and completely ineligible for a deduction at $76,000 or beyond. If you're married, filing jointly, it is $105,000 to $125,000. And if you're married and you are not covered by a retirement plan, but your spouse is, then the limits are higher. It's $198,000 to $208,000. And it's important to note that there is no income limit to contribute to a traditional IRA and get the tax deduction as long as neither you nor your spouse has a company retirement plan. The phase-out ranges are only for those who are covered by a work plan. And if you are, your W-2 will have a check mark in the retirement plan box. If your income surpasses these thresholds, but you want to make an IRA contribution, you still can, but you lose the tax deduction, and your contribution will be made with after-tax dollars. When you do this, you now have a traditional IRA with both pre-tax and post-tax dollars within the same IRA, assuming you had an existing IRA with post-tax dollars. Again, take a look at my screen here. As for tracking basis within your traditional IRA, it is done on Form 8606. This form tracks IRA basis and lets the IRS know that a person has after-tax dollars in their IRA. Form 8606 will need to be filed every year that a non-deductible IRA contribution is made. Failure to file the 8606 means the person will be taxed again on the same dollars when they withdraw in the future. So filing the 8606 is important. Fairly often I have clients that would like to contribute to a Roth IRA, but they are unable based on their income level. They can still do a backdoor Roth, but when they are making after-tax IRA contributions and then converting to Roth, the pro-rata rule comes into play. I recently had a client with a sizable IRA in this situation, and they asked if they could set up a new IRA account to keep track of just the after-tax contributions, so they would be separate of their other IRA funds. So it would be easier to know which of their IRA accounts were pre-tax and which was after-tax. The problem is the IRS considers all of a person's IRAs as one big IRA. It doesn't matter where the IRAs are or how many different accounts that you may have. The IRS sees just one big IRA bucket. The pro-rata rule says we need to consider all of their IRA accounts, the entire IRA bucket, and see what percentage is pre-tax and what is after-tax. Any Roth conversions will mimic that percentage of taxability. I recognize that there's a lot of moving parts here, and when it comes to tax rules, they are anything but simple. I hope to make it easy for you to understand this complex concepts. I'm going to give you an example scenario here, okay? Back to my screen. Hypothetically, assume your traditional IRA is 100% pre-tax dollars and is worth $93,000. Also assume this is your only IRA, just to get the concept. No others in any other bank, and no Roth IRA, okay? You make a non-deductible after-tax contribution of $7,000. Now your traditional IRA is worth $100,000, but the ratio between pre-tax and after-tax is 93% to 7%. Based on that 93-7 ratio, every conversion will be 93% taxable, regardless of how much you convert. So assume you convert $7,000, it will be 93% taxable, but you are not paying tax twice, although it may feel that way. Of the $7,000 conversion, you will pay tax on $6,510. The remaining $490 is tax-free. Based on your 93-7 ratio, the conversion essentially grabs $6,510 from the pre-tax money in the traditional IRA that you never paid tax on, and then it grabs the $490 from the after-tax portion. When those dollars hit the Roth IRA after conversion, they are then 100% after tax. But we only grabbed $490 of the after-tax dollars from the traditional IRA. The remaining $5,010 of your $7,000 after-tax dollar contribution remains behind in the traditional IRA. After the $7,000 conversion, your traditional IRA is again worth $93,000, but it now consists of $86,490 in pre-tax dollars and $6,510 in basis. Guess what the ratio is between those numbers? 93% to 7%. At that point, in addition to the $6,510 in basis in the traditional IRA, you would also have $7,000 of after-tax money in the Roth. Every year that you make new non-deductible contributions, it will change the amount of basis in the traditional IRA and change the ratio of the conversion. Upon future Roth conversions, you will continue to carve out chunks of the pre-tax portion of your traditional IRA and pay tax on those never taxed dollars. You will also not pay tax on the smaller chunks of the after-tax dollars that get converted. So I hope that you found this educational. I know it's can seem kind of complex, and it is quite complex. But hopefully, maybe you have to watch this twice to kind of let these concepts sink in. But I hope you found this video educational, and I look forward to seeing you in the next episode of the Financial Fast Lane.